Okay, how's everybody doing? Woo, I love the after lunch session because everybody is not full of food, not ready for a nap, totally ready to just charge right into 2 hours of equity compensation. Yay, it's true. I promised there was a title slide here, but just pretend it says stock options. And then we'll bounce over there. You probably recognize me from that introduction. I am the co-owner of Brass Tax Presentations, and I also somehow, I still don't totally know how that works, have a fully functioning tax business. It's called Shannon Tax because apparently I'm not that creative with naming. Also, I didn't want to get a DBA because I'm lazy. So that's me. I like to have a lot of fun. I like to make 2 promises at the start of each of my presentations. The first one is that you will not be bored, and the second one is that you will learn at least one new thing. So I'm going to do my best to make sure that I keep both of those promises as we go through. Not that you will never be bored, because sometimes things get a little weedy. But overall, the goal is to keep you laughing, having fun, and learning stuff. So, equity compensation. What is it? When you get paid by an employer, when you get anything from your employer, it's going to be one of 2 things. It's either going to be compensation or it's going to be a non-taxable fringe benefit. I really like Code Section 61A. I like it enough that I have it tattooed on my arm. And that is a true statement. If you don't believe me, you can come see it. It was my birthday a couple years ago, and Ryan and I were nerding out, and my friend was like, when are you guys getting your code section tattoos? And so I went and got one. We were supposed to both get them, but guess what? So I have it, and then somebody was like, why do you have Code Section 61A tattooed on you? And I was like, well, because you don't want to get something like 199A that might go away, right? You want something you know is going to be around for a while. And also, I like the idea of gross income. I think it's fun. But because I like to get kind of into weird stuff like illegal businesses and like how that all gets taxed, I think that's fascinating. And tax really touches every parts of our lives, right? Any situation that comes up, I can bring it back to tax, which makes everyone in my life very excited. Let me tell you. But so what 61A says is all income from all sources is taxable unless it is specifically excluded. And so when we get employers who are giving things to their employees, usually in the form of money, but sometimes in the form of other benefits, it's either going to be compensation, which means that it is taxable, or it's a tax-free fringe benefit. So what are the benefits? Well, health insurance generally is going to be a tax-free fringe benefit, retirement plans, things like that, certain allowances for parking and transportation, although we know now, not bicycle commuting anymore. Very sad. If you get an employee discount, as long as it doesn't exceed certain thresholds, that's generally not a taxable benefit. Anything else, taxable compensation, if it doesn't fall within the very specific definitions of fringe benefits. So what we're going to be talking about with this kind of equity compensation, it's generally going to be taxable. The question we have to answer is when, and what's the character of the income that we have to recognize. Is it ordinary income? Is it capital gain? When do we have to throw that on the return? And so that's what we're going to go through and look at today. There are some special terms that you want to know when we're talking about stock options. It sort of has a vocabulary all its own. The first one is the grant. So when you get a grant from the employer, it means that you have been given it. That's all it is. The grant means I gave you the option to buy stock in my company. And we need to know when the grant date was because a lot of our holding periods, a lot of the recognition events can happen based on when the grant date is. We also have the term exercise, which means that you are actually purchasing the shares. So I have given you the option to buy them. You don't have to, it's an option. But when you decide that you do want to actually purchase those shares, you exercise the option, and that is when, that's the exercise date. We also have this idea of vesting. So you can have an employee where, well, let's go back. Let's say that I bring a new employee into my company, and I want to give them some sort of ownership. So I say, you know, I would like it if you kind of were bought into my company, literally. So I'm going to give you the right to buy stock in my company. I'm going to give you that option. This person got hired 2 weeks ago. Do I want to just give them all that stock in my company right away? No, right? Because they'll just buy it and then they'll take off. There's nothing to keep them there. So usually when we have this sort of equity compensation, there's a vesting schedule, which means you are going to get these options, but they're not vested. You can't actually exercise them, or you don't have that stock until a period of time has elapsed. Usually it's a couple of years. So I say, I'm going to give you this option, but you have to wait 2 years before it's vested and you can actually do anything with it. That's a little bit more of an incentive to keep those employees around. Restricted stock means that there are some restrictions on it, obviously. It is kind of like non-vested stock. So if I have stock that hasn't fully vested, I don't own it, I can't do whatever I want with it. I can't take it and transfer it or sell it or do any of that. It's restricted. And so when we talk about restricted stock units and restricted stock awards, these are types of equity compensation that I cannot do whatever I want with freely. There are restrictions on them. Compensatory stock benefits are just everything we're talking about today. Anytime I'm giving my employees stock instead of money, that's a compensatory stock benefit. We're not talking about gifts here. That's kind of a different thing. So generally, if I'm performing services for something, for someone, and they give me something in return, whether it's property, whether it's cash, that's compensation to me, right? I perform services, I get something in return, and that's going to be taxable income to me. Generally, if I get stock in exchange for the services that I perform, then it's going to be taxable when I get it, and that amount is going to be equal to the fair market value, less anything that I actually pay out of pocket to buy it. So normally when we're talking about these kinds of exchanges, my employer says, hey, I'm giving you the option to buy stock in my company for less than what it actually costs. I'm buying it at a discount. And maybe I go out of pocket to purchase it, and then the difference between what I pay for it and what it should have cost me, what the fair market value is, that's the part that is treated as income. And that's what's going to show up on my W-2 or sometimes on an AMT schedule. We'll talk about that later. So as I said, an option means it's a choice. It's the Hamlet of taxes, to buy or not to buy. That is the question. Thank you. You don't have to do it. It's an option, not required. When it's granted, we give them the option, and there's usually a fixed period of time when you can actually exercise it. A lot of times, we'll say, okay, so I've given you this option, but you have to exercise within 5 or 10 years. You can't have an indefinite option to go on and purchase this stock. And so there are some planning strategies that we'll talk about later on if you know that your option period is ending, if those options are expiring. And like we said, the grant date is when the option is granted to that worker. When you actually make the purchase, that's the exercise date. The option price, also called the exercise price, is the amount that I, as the employee, am going to pay to purchase the stock. It's not the fair market value, it's what my price is. It's my discounted amount. And then the option privilege is just the option to buy or sell. We talked about vesting period. It's usually a couple of years. Generally, we can't transfer options except on divorce or death. If I have options in my company, I can't give them to my kid. I can't give them to my grandmother unless I die and I leave them to them. We get to buy it at a discount. That's the nice thing about it. Now, once we grant the option to the employee, if they come back and say, I would like to exercise my options, I have to sell them those options. I can't say, oh, it's not a good time for me. It's a requirement. Once you give them that, they have to be able to exercise it. So what are the benefits to the employer here? Why would an employer want to do this instead of just giving their employee money? It keeps them sort of invested in the company, literally invested in the company, right? If I own stock in the company and the company does well, I benefit from that. It also means I don't have to put any actual cash out. I can keep all those funds in reserve in my bank accounts, and I just say, hey, I'm giving you stock in the company. What, Ryan's very excited about this. He says that's the best. And it's an employee retention tool. You know, there's a lot of competition. People are coming out of college looking for jobs, and employers are trying to get and retain that top talent. And offering them equity in the company is a great way to do that. For the employees, sometimes these stock options can be way more valuable than the actual money they would get just getting paid. Imagine, let's take a moment. Let's go on a little flight of fancy together, and let's pretend that it's 1998, maybe early 2000, and we all get a job at one of the big tech startups. Maybe we all work at Google. And as part of our employment contract, we got options in the company. How are we feeling today? We're feeling pretty great, right? And we're living pretty high on the hog because of that. That's way more of a benefit than any of those workers ever would have gotten just from getting their salary, right? So it can be a huge benefit for employees. Some types of options receive favorable tax treatment. We'll talk about my personal favorite. And they can be sort of a form of forced savings. People, there was some, what's the statistic? 83% of Americans don't have any emergency savings. Did you know, by the way, that 27% of statistics are made up on the spot? But this is a way to kind of say, yeah, you have this item, you have this money, but we're holding on to it for you until later on. It forces them to save a little bit. There are, of course, drawbacks. Not every company is Google. Not every company is Facebook or Meta, they call it now, whatever these happen to be. Sometimes you can get the stock in the company, and maybe it's Beyond Meat, which we tragically invested, and now the value is way down. And so you don't get that benefit of the huge appreciation there. Maybe you don't want to buy stock in that company. Maybe you don't like the company you work for, and so you'd rather not give them any of your money, even if it's to buy a discounted option. So pros and cons on both sides there. So the first kind of option we're going to talk about is statutory options. There's two main types here: incentive stock options and employee stock purchase plans. There are a couple of conditions that they have to meet in order to be statutory options. The first one is that they are non-transferable except at death or divorce. Ordinary income for statutory options isn't reported until the shares are actually sold, which is different than the way we treat the non-statutory options. Only employees can get these, so you can't give ISOs or ESPPs to independent contractors or board members or anything like that. There is a 10-year exercise window in order to qualify, and the price has to be at least equal to the fair market value of the stock on the date of the grant. As long as it meets all of these conditions, it can be a statutory option. Now, I know that you're not supposed to have favorites. I love all of my children equally, but I do like incentive stock options the best because they have really the best benefit. If you do ISOs right, it's the best of all the world. Because when you exercise your ISOs, there is no ordinary income component here. It is only an alternative minimum tax item. So if you can keep it where you're under AMT, you don't pay any ordinary income tax, and as long as you meet the holding periods, when you sell it, it's all capital gains. Best of both worlds. Now the bargain element, which we also call the spread, which is the difference between my exercise price and the fair market value, that's the amount that we're going to include when we're doing our AMT calculation. Now I said you weren't going to get bored, but I'm going to talk about AMT. I love AMT. Not as a concept, but just because I think it's interesting. But if we're going to talk about incentive stock options, we have to talk a little bit about AMT. So what is the alternative minimum tax? It's a tax that runs sort of right alongside the regular income tax, and every time you do a tax return, your software is also calculating AMT, even Drake. Does it in the back. If you weren't in Ryan's class earlier, Ryan uses Lacert, I use Drake. It's very funny. But I think it's good because we can, when people are like, well, does Drake do that? I can just say no. Although you can do that anyway, probably. But the software will run both of these calculations concurrently. It says, okay, here's the regular tax and here's the alternative minimum tax. And AMT basically came about because they wanted rich people to pay their fair share. Does that sound familiar? This is sort of a common refrain throughout all of our history of tax. So they said, there's all these wealthy individuals, high-value taxpayers, who are taking advantage of all of these tax breaks, huge state and local tax deductions, qualified small business stocks, specified private activity bonds, all of these things that are AMT items. And they said, that's not really fair. They're doing all of these things. They're not really paying what they should. So they came up with the alternative minimum tax, which is exactly what it sounds like. It's a minimum tax. It says this is the least amount that these people can pay because we want it to be fair. So we go in and we start adding things back in, we start taking benefits out so that we get to the alternative minimum taxable income. And then we figure out the tentative minimum tax, which is the lowest amount of tax they can pay. If the tentative minimum tax is higher than their regular tax, that's when AMT comes into play. If the tentative minimum tax is lower, then nobody cares. We don't even look at the 6251, and we all go and have a nice day. When you pay AMT for something that's called a deferral item or a timing difference, it creates a credit for the alternative minimum tax that you pay. The exercise of incentive stock options is a timing difference. It's a deferral item. So if I exercise my incentive stock options and I pay alternative minimum tax because of that, then in the next year or the year after that, if I don't have AMT, I get to take a credit for the AMT that I paid. So even if you bump into AMT because of these exercises, it's not that big a deal. You're going to get it back later. The One Big Beautiful Bill increased the AMT exemption amount, so we'll still start to see fewer and fewer people impacted by AMT. But really the only time I've seen it in my practice is with clients who are exercising ISOs. I haven't seen anything else that's triggered it because most of the triggers are gone.
Oil and gas.
Oh, oil and gas. Well, I said in my practice. I don't have that many oil and gas clients. I just send them all to Ryan. So we talked about this already. We can't reduce our tax below the tentative minimum tax using the credit for prior year tax because that would just be funny. When you have clients who have exercises of incentive stock options, there's a couple of forms we need. The first one is this. It's the 3921, and this will give us all of the information that we need to calculate the AMT. It'll tell us the date the option was granted, the date it was exercised, what the exercise price per share was, what the fair market value per share was on the exercise date, the number of shares that were transferred. And then we're going to take that information and we're going to jump over to the 6251. We figure out what their exercise price was, so what they paid for it, what the fair market value was, what the difference is, and the difference goes right there on the exercise of incentive stock options line. And then we use that to figure out what our AMT is. So let's take a look at an example here. Incentivized Irma, she was granted incentive stock options, and she purchased shares of the employer's stock. Her regular income tax that year was $18,000. So based on all of her other income, her salary, if she had interest or dividends or anything like that, her tax for the year was 18 grand. The AMT on her exercise was $206,000. Yeah. Now let me ask you, when you exercise these options, do you actually get any money? No. So she paid $206,000 of AMT on income she never got, which maybe wasn't that bad, except that the year after the exercise, what happened to the fair market value of those shares? It plummeted. So now, even if she sold that stock, she can't pay off the tax that she owes because the value is completely gone. So she works out a payment plan. She says, listen, I can't pay this right now because I don't actually have any money. So I'm just going to get on an installment agreement. They say, great. She comes back and says, hey, listen, how about we just do an offer and compromise? And they say, sorry, but no. And she's stuck paying AMT on income that she will never get. And this happened a lot because when they had the dot-com boom, there were all these companies and they had these huge valuations. People were paying AMT on their incentive stock options all over the place. And then all of those companies crashed, and there were a lot of taxpayers who ended up in the situation that Irma was in, where they had all of this AMT, but no actual income to speak of. And so they passed the Emergency Economic Stabilization Act back in 2008, and there were some provisions in there that offered this sort of sweeping relief to people in that situation. I don't think that we will see that kind of relief again. So if you have clients who end up in this situation, they're probably just out of luck. And you have to keep on paying that AMT, which is a real bummer. So I said if you do the ISOs right, they're the best ones. And when you do it right, it means that you do a qualifying transfer. You meet the holding periods, and that means that you hold on to it for 2 years from the grant date and 1 year from the transfer of the shares, which is the exercise date. So if I do that, I pay maybe AMT, but if I don't trigger alternative minimum tax, then I don't pay any tax on the exercise at all. There's no ordinary income component, there's nothing. And then when I sell those shares, as long as I wait a year from the date it was transferred, then all I pay is long-term capital gains. And this is fantastic. There are some limits. You can only do $100,000 of fair market value during 1 calendar year. Anything else becomes a non-qualified option. We'll talk about that in a little bit. So what if I don't meet the holding periods? I fought with the client for several weeks about this, because he had a bunch of ISOs, he wanted to exercise them, but he wanted to exercise and sell in the same year, which means that is a disqualifying disposition, and we recognize ordinary income in the year of the sale if we do that. So remember before, I do my exercise, if I don't trigger AMT, I hold them long enough, I sell them, it's all capital gains. If I don't meet the holding period, all of that, the difference between my exercise price and the fair market value, the spread, all hits my W-2 as ordinary income in the year of the exercise. And no capital gain treatment at all. So we really want to discourage people from doing this, because you take the best tax treatment for incentives for any kind of equity compensation, and you completely destroy it by doing this. And this guy had several $100,000 of ISOs that he was exercising and selling. And it was a giant tax bill that he ended up with, and I couldn't talk him out of it. There was no way that he wasn't going to do it, so he ended up paying a really, really huge tax bill. And then was confused. He was like, why are my taxes so high? And I was like, because I told you not to do that. But people don't always listen to us, right? Even if they do call us first, which they don't always, even if they do, they don't always listen. So disqualifying Daniel, he was granted an incentive stock option on February 2nd, 2023 to buy 1,000 shares of the employer stock at $10 a share. So his exercise price is $10. He exercised the ISOs in January of 2024, and at that time the fair market value of the stock was $15 per share. So what's the bargain element here? What's the spread? $5, right? The $10 exercise price, $15 fair market value. Then in August, he decides he doesn't want to hold on to these shares anymore. He's just going to sell them all. So he sells them when they're trading for $20 a share. So what does this look like? Well, we've got $20,000 of gross proceeds on the 1099-B, less what he actually paid, the $10 per share. So he's got $10,000 of basis. He's going to get $5,000 dropped onto his W-2, which is the ordinary income component of this. His total basis is the $10,000 he paid plus the ordinary income that he recognized. When you have ordinary income from the transfers of employee stock, it adds to the basis. So he has $5,000 of short-term capital gain. So he took something that could have been all long-term capital gain, and he made it all into short-term capital gain and ordinary income. Not the best way to do it. He didn't meet the holding period, so he recognizes $5,000 of ordinary income, $5,000 short-term gain. Now, when you have statutory stock options, there's no FICA component here. So you're not paying Social Security or Medicare taxes. With non-qualified options, we do, but we do save ourselves those payroll taxes on these kinds of transfers. So those are incentive stock options. The other kind of statutory option is employee stock purchase plans. I used to make a joke because there's a provision in the law that says you can exclude highly paid or highly compensated employees from the employee stock purchase plans. And my husband has been doing the employee stock purchase plan at his job for a long time. And I was like, well, you know, my husband's not a highly compensated employee, which is probably not very nice of me. But he wasn't there. He doesn't know. The best was that was on my wedding anniversary. I made that joke, which is also kind of uncool. Anyway, so this gives the employees the option to purchase the stock in their company. A lot of big companies do this. I see that my husband works for Disney, so we buy Disney stock under the employee stock purchase plan. I have some clients that do this that work for Salesforce, some of the other big tech companies. And you generally are buying them through payroll deferrals. So you're not going out of pocket on anything. You just say, take a chunk of my paycheck and just use it to buy stock in the company. And you buy it for a little bit of a discount. Now, when you have employee stock purchase plans, there's no AMT component here, but the weird thing is that you don't recognize any income when you exercise them. You recognize the income when you sell them. And so you could be buying shares under employee stock purchase plans for years and years and years and years and never recognize any income until many years later when you sell them, and you'll get a W-2 reporting the ordinary income that you had from the discount. There's a limit on the exercise. You can only do $25,000 a year. And they have to be granted to all the employees unless you can exclude them. If it's somebody who's only been there a couple of years, you don't have to let them buy in. If they work 20 hours or less a week, if they're seasonal employees, you don't have to let them participate in an ESPP. And the highly compensated employees, you can leave them out if you want to. You don't have to, but you can. Now you'll get this form, the 3922, and this tells you, I get these from clients, and I usually just kind of ignore them, because for the most part, the brokerage houses will track these things for you. But there is one that I take huge amounts of umbrage with right now because they've made me crazy. Merrill is on my hit list, right? Okay, the worst. I spent an hour on the phone on a conference call with my client and the phone agent at Merrill, who is not his fault, he didn't really know, but it was October 6th. And this guy was telling me that there is no such document that will show the ordinary income component, and I was losing my mind about it. So luckily, I had the stupid 3922 in my files from many years ago, and I went back and had to manually calculate what the income was, which was super fun for me to do on October 6th. But this will tell us that they exercised their ESPPs. It tells us what the fair market value was on the grant date, what it was on the exercise date, because we need to know both of those amounts. We sell the shares, we get the sale reported on a 1099-B, and the income reported on the W-2. And then hopefully a helpful supplemental statement from the brokerage house, although probably not. If you have a qualifying disposition, it means that you hold the shares from 2 years from the grant date and 1 year from the exercise date. And in this case, we have a long-term capital gain, and it's the difference between the selling price of the stock and the option paid on the date of the option price on the date of the exercise. If we have a, hold on, let's skip over here. Let's look at an example. Poly purchase plan. So on March 1st of 2020, she was granted the option to buy 1,000 shares of the employer stock for $20 a share. At the time, it was $22 a share, so she got a $2 discount. She exercises the option on May 1st of 2022, and at that time, the fair market value was $23 a share. Then, in November of 2023, she sells the shares for $30. So did she meet the holding periods? Yeah, she waited 2 years from the grant date and a year from the exercise date. So she's going to get a 1099-B that shows gross proceeds of $30,000. We're going to take out the cost of the stock that she actually paid out of pocket, which is 20 grand. And then we have that W-2 income from the discount. She got a $2 discount times 1,000 shares, so that's a $2,000 discount. So her total basis is 22 grand. She's got a long-term capital gain of $8,000. Is everybody with me so far? All right. So she's going to report $2,000 of ordinary income. It's going to be on her W-2, and then we've got the capital gain of 8 grand. Now, if you sell them without meeting those holding periods, everything mechanically works the same, except instead of the date of the grant being the value that we use to figure out what our discount is, we use the date of the exercise. So generally, this is going to give you more ordinary income. So we've got, let's see, we have an example in here, I think. No, I'm just kidding. Okay, I can't go backwards. Sorry, hold on. Technology. Okay, so the key is, did you meet the holding periods? Are we looking for the fair market value on the date of the grant or the fair market value on the date of the exercise? If you do a same-day sale of an incentive stock option or an employee stock purchase plan share, the transfer is being, or the title is being transferred to the employee, so you'll see those same-day sales on the brokerage statement. With other kinds of options, you don't see those show up, so you don't have to go digging looking for shares that aren't going to be shown there. So those are the statutory options. Yeah. So the question is, if you were working for them and then you leave the company and you sell them, you'll get a W-2. And it happens. Has anybody had this happen where the client leaves the company and then they get a W-2 years later and they're like, this is wrong, this is a mistake, because they don't understand what happened. Yeah, and it's not wrong, it's not a mistake, it means that they had some stock options there. Life insurance people? Oh, yeah. Yeah, so it's really funny. I think that sometimes our clients tell us what we're going to specialize in. Sometimes you get to pick, but sometimes your clients tell you, and I ended up acquiring a practice that was an entirely virtual company that was based out of San Francisco, and so they had a lot of these kinds of clients. And so that's how I ended up learning about all of this compensation stuff, is because I had to figure it out, because they kept showing up with this stuff, and I'm like, what is happening? But I think it's really fun because they're like little puzzles that we get to do. So then we have the statutory options, ISOs, ESPPs. Everything else basically non-statutory option. And what does that mean? Well, it means that it's not statutory. I love definitions like that. If it doesn't meet those requirements to be a statutory option, it means it's a non-statutory option. That's the definition. With these, the stock is taxed at the time of the exercise or the time of the transfer. So with our ISOs and our ESPPs, generally we don't recognize the income until we sell them. With NSOs, we recognize it when we exercise. Generally, there's going to be payroll taxes, so FICA, all of those other good things, that shows up on there. And then we have wages. So we have whatever the fair market value of the stock is at the date of the exercise, minus the amount that we actually paid out of pocket for that option. That's the ordinary income that's going to drop onto our W-2. These are supposed to be reported in box 12 code V, but they are not always. It's very inconsistent. I've seen them a handful of times, but payroll companies tend to not really pay that much attention to it, so it's not really reliable. With these non-statutory options, you can transfer them. A lot of executives get these kind of options because they don't have the same limitations. You could transfer somebody $3 million of restricted stock units in the year, and there's not any kind of an issue with that. You can also give them to people other than employees. So if you have contractors that are working for your company, you can give your contractors non-qualified options or non-statutory options. It'll tell you that that's what's happening. Once it's taxed, you're going to recognize the ordinary income when you exercise, and then from there on out, everything else is either short-term or long-term capital gain. And there are some really fun games that you can play with planning when it comes to these kinds of options and seeing when do you want to exercise, when do you want to sell, what gives you the better outcome versus holding it now and paying more long-term capital gains, especially when you start to get into some of the higher income levels when you're dealing with net investment income tax. Sometimes if somebody's already hit the Social Security wage limit, they get a better benefit from actually exercising early. So you play a lot of fun games. Now there are some times when maybe you would get taxed at the grant, but it's only if there's a readily determinable value. So if you have a tiny little startup and nobody knows what the value of the stock is, you're not going to tax at the grant because you don't know how much income that you would recognize. Generally, bigger companies, if they're publicly traded, it's easier to determine what that value is. So RSUs are restricted stock units. You can always tell that somebody has an RSU because you'll get a 1099-B and the basis is 0. That's how you know. You also know because they have really huge W-2s with not enough withholding on them. That's usually kind of a dead giveaway, right? I don't know why. The supplemental withholding rates are useless until you get over $1 million. And then they're actually helpful. But the supplemental withholding is 22%. And so if I'm a person who has a regular salary of $300,000 and I get $500,000 of RSUs in that year, is 22% going to be anywhere close to enough? No. And so they end up with giant tax bills usually and don't understand why. And the reason is because they have these big RSU vests. When the RSU vests, which means that all of the restrictions are released, and I can now sell those shares, I can do whatever I want with them, at the vesting, the income hits my return. I don't pay anything out of pocket for RSUs. They just get dropped right into my brokerage account, and all of that income gets dropped right onto my W-2, subject to payroll taxes, all of that good stuff. It's in box 1, 3, and 5, and it should say RSU in box 14. And that they do tend to be a little bit better about. Sometimes, not always. The W-2 is the worst place to go looking for clues about this. It can sometimes tell you that they are getting employee stock, but it's not really super helpful. So restricted Ronald, he got some RSUs on February 2nd of 2020. He got the grant, and he was going to receive 1,000 shares of the stock at no cost to him, but he had to stay there for 2 years. After the 2 years passed, then he gets all of that stock. All of the RSUs vest, drops right into the account. At the time of the grant, the fair market value was $25 a share. On February 2nd of 2022, the title transfers over to Ronald. The shares are fully vested. On that date, the fair market value is $30 per share. Then on March 25th of 23, he sells all of the shares for 35 bucks. So when is he going to recognize income, and how much is he going to recognize? Does he recognize income when he gets the grant? No, because nothing's happened. He doesn't actually have those shares. They're restricted still. Does he recognize income when they vest? Yes, right? And what's the amount of income we're going to recognize? $30,000. 1,000 shares times $30 fair market value. So $30,000 of income lands on his W-2. Then when he sells it, what happens? He's got a $5,000 capital gain. He's going to get a 1099-B that shows $35,000 sales proceeds, 0 basis. And that's always the thing. A lot of times we have to kind of be detectives when we're doing our clients' returns. And so if you get a 1099-B and you see 0 basis, there's a couple of things that could do that, right? They could have maybe inherited stock from a grandparent that was in the account from before they had to track the basis. That was a thing. Maybe they've had it since before the brokerage houses had to share the basis, so nobody knows what the basis is. But if you see that 0 on the basis and the name of the stock is the same name as their employer, there's a really good chance that that's what's happening. That's a huge clue, right? And sometimes, especially if you have clients, a lot of my clients are tech people, and so I had this one client, they had shares of TrueCar, I think it was one of the car rental things, and it was a huge gain. Their basis was really, really low. It was a giant gain, but they didn't work there, and so I said, hey, did you work for them at some point? Was this employee stock? And they said, no, that was just a great investment. So sometimes that's just what happens, but you have to ask the questions, because a lot of times, super low basis, really high capital gain, maybe that's employee stock. Let's see. It's wages. We've got payroll taxes. They have to do the withholding. Again, 22%, usually not really going to help much, but it does a little bit. And a lot of times what they'll do is they'll sell to cover the taxes. So when these RSU shares vest, not all of the shares that they get will go into their account. They'll sell off a chunk of the stock to cover the taxes for the employee, and then everything that's left over goes into the brokerage account. The sale to cover shares are generally not reported on their brokerage statement because they never actually transferred title. The company sold and used them to pay the taxes, so we don't usually see those show up. Let's see. We talked about all of this. Oh, man. I'm not going to go up there again. The thing to know about this is that sometimes employers will allow the employees to pay cash for the exercise or to pay cash to pay the taxes. But most of the time, it's not really going to do you any good. You don't benefit from going out of pocket to pay the taxes because you could just buy more stock. You end up in kind of the exact same place. And a lot of the employers won't let you do the cash. They require a sell to cover. So here's an example of what this looks like. We've got Gregory Grants. He was granted 1,200 restricted stock units. The units are going to vest 1/3 each year for the next 3 years. On July 1st of 2024, 400 of his shares vest. The fair market value is $100 a share. The employer is going to sell some of the shares to cover the taxes from the vest. So he will have, what is that, $4,000 of income? I can't do that kind of math. It's 40? See, I don't do math like that in my head. Okay, hey, $40,000 of wage income. This is what calculators are for, my friends. He's got FICA, federal and state withholding, of $17,640. So they're going to sell 176.4 shares to cover all of the taxes. And then the remaining 223.6 shares get dropped into Gregory's brokerage account. And this is going to rinse and repeat over the next 3 years as the remaining shares vest. Now there's another kind of restricted stock. It's called a restricted stock award. And this is treated differently from RSUs. When I get RSUs, I get the option for my RSUs. And when they vest, I recognize the income. I get the shares. They're in my hands. With an RSA, the shares get transferred to the employee before they're fully vested. So even though I have them, they're in my hands, I can't do whatever I want with them. I can't sell them, I can't exchange them, I can't transfer them. They have these restrictions on them. They're non-transferable, and they're subject to forfeiture. So if something happened in between, then those shares revert back to the company. When we have these restricted stock awards, we recognize it once it becomes vested and the restrictions are removed. But there's this kind of fun thing that we can do with restricted stock awards called an 83B election. Has anybody heard of these? A couple of people, all right. So 83B lets me do something kind of cool. So let's say, Ryan, I'm sorry.
Don't you do this to me.
I'm going to do it to you. I'm going to do it. So let's say I've been working with Ryan for a little bit, and Ryan says, hey, you know what, Shannon, you're doing a great job. I would like to give you some stock in my company. And I say, that sounds fantastic. I would love that. So he says, okay, but I'm going to give you the stock right now. I'm handing it to you, but you have to stay working at my company for the next 3 years, and if you don't, I'm taking it back. I'm giving it to you, you've got it, I'm holding it, but if I leave the company before 3 years is up, he's just going to snatch it and take it right back. So this is a restricted stock award. Now let's say, I'm sorry, that at the time that he gives me that stock, the value of that stock is $0.
Whoa.
I know. But I think that in a couple of years, in the 3 years when that stock is fully vested, I think that that stock's going to be worth $500,000. Now, when we have restricted stock awards, you recognize the income when the stock vests. I can make an 83B election because it is already in my hands and because I have this risk of forfeiture, and I can choose to recognize the income when I actually get it, at the time of the grant. So let me ask you, would you rather pay tax on $500,000 or $0? I mean, you could think about it if you want. I would rather pay tax on $0, right? Wouldn't you? Yeah, so I can make an 83B election. I opt to pay the tax at the time of the grant, not at the time of the vest, and I recognize $0 of tax, or $0 of income. I pay no tax on it. And then, once those shares are vested and I ultimately sell them, everything is capital gain. Sounds pretty good, right? Is there any kind of a maybe downside here? Not if it's zero. Yeah, there's very little downside if the value of the stock is zero. But let's say in a more real world kind of an example.
Yeah, exactly.
Let's say, yeah, you have no basis. If you make the 83B election and the fair market value is zero and you recognize no income, your basis is zero too. But it's all just capital gain at that point. And if it's long-term gains, we love that. But let's say that the value of the company, what do you want it to be? You can pick.
I mean, at least $1 million total.
Okay.
I don't know why everybody's laughing. We're very popular.
So Ryan's grant of he's got $1 million valuation, so his grant to me is $25. And so not funny? Okay.
Oh, no. Absolutely not.
So let's say that the shares that he gives me, the restricted stock award that he gives me, at the time of the grant has a fair market value of $500,000. Now, I believe that in these 3 years, it's going to be $2 million. And I would rather pay tax on $500,000 than $2 million, right? So I make the 83B election. What happens if the value goes down? I'm kind of screwed, but I could sell it, and I've got my basis, I recognized all of that income. So if I sell it at a loss, I get a capital loss, but you know what's worse? Let's say Ryan gives me the stock, I make the 83B election, I pay tax on $500,000. After a year and a half, I can't stand this guy. I can't look at his face. I don't want to hang out with him anymore. I'm like, Ryan, I can't do this. I'm out. And he says, cool, I will take all of that stock back, thank you, because it hasn't fully vested. So he reaches in, he yoinks back all of that stock, so now what do I have? Nothing. Do I get to take a loss? Do I get to deduct anything? No, I get nothing.
Does he get your basis?
No, he just gets my stock. So there is a risk to this, yes.
Is there ever a scenario where he can decide to just take it back and if you stay at the company?
Not if so the question was, can he just take it back even if I stay at the company?
It's performance-based.
If it's, yeah, it depends on how it, whoa, did you see his eyes light up, you guys?
There is a performance-based thing in our contract.
That's true, there is. So if there is something like, if it is based on performance, and if they fire you, they take it back. Which actually happened to a client of mine. He did an 83 election on, it was a couple $100,000 worth of RSAs, and then he got fired like 5 months later. Yes?
The 83B election, while it used to be like a typewritten document that you have to forward it, they've actually issued a form for it now.
I wish I could see what's happening next. Yeah, so you make this, we kind of talked about this is all fun. This is the form. I love new forms. Nobody else, I try to get new forms chants going when we do our club. I'm like, new forms, nobody does it. But I do like a form. So there's a sample election in the book there, and we used to just kind of write it all out. It was like, here's my name, here's my ID number, these are the number of shares I'm transferring, this is the fair market value, this is the amount of income I'm recognizing, and it was all kind of vague. Usually the people that were granting the stock, the company would kind of prepare that and put it in the grant documents, and then the person would just sign it and mail it off. But now we have this form, which maybe we'll get to e-file them now? No? You don't think so?
Maybe one day.
Maybe one day, not now, but like maybe because we have a standardized form, because you still have to mail them in. You make the election, has to be made within 30 days, you mail it in certified mail, right? Everybody, we never mail anything to the IRS that isn't certified, because they're certifiable. Anyway, my retirement job is Jungle Cruise skipper at Disneyland, so just in case anyone was wondering. So yeah, so now we have this form. It takes all the guesswork out of making this election. You fill it in, you mail it in. We used to have to attach a copy of the 83B election with the tax return, but we don't have to do that anymore. You can ask them to send, if you send them a SASE, I call it, a self-addressed stamped envelope, they will allegedly mail you back the thing that says, yes, we accepted your election. Otherwise, yes, they do it. Otherwise, you just kind of like cross your fingers and hope that they went for it. Right now, cross your fingers, yeah. Yeah, well, since they're trying to cut down on the amount of mail that's going into the service, I am hopeful that this means we're moving toward an electronic filing option, but we'll see.
Now, what happens if you can insert a provision if there's like a liquidating event? Let's say if the company gets sold after you make the 83B election, do all the benefits of 83B accelerate if that liquidating event takes place?
I mean, assuming that the stock, that there's nothing that would cause you to have to forfeit the stock, then yeah, you've made the election if you, at that point, you've already recognized the income, so you've just got nothing but gain, capital gain. So yeah, So it's a cool thing to do. It is not without risk if there is a fair market value. If there's no value, if it's zero, make an 83B election all day long because there's no downside. New form, new what? This was last year, I think, right? When they introduced it was, yeah.
Last year.
Yes, I told this whole story in the update last year. Yes.
Is there anything for death or disability situation?
For the forfeiture of the shares, you mean?
Does it have to be written in?
Yeah, I imagine in that there would probably be some sort of a provision of what would happen if you die written into the yeah, giant contract. There has to be something, I would imagine this is if this person dies before they're vested, they either revert back to the company or go to the heirs. Yeah.
Is there any restriction as to what kind of companies are able to offer this? Like, I'm thinking like tax as partnerships offering benefits to key employees. Like income only, what's the word for it?
The rules for partnerships get a little bit weirder. These are generally, yeah,
If it's a profits interest, generally it's not taxable on receipt anyway, but if it's a capital interest, then you might be able to do an 83B election for a capital interest.
but there have to be restrictions on it. It can't be, yes, thank you. Okay. So we have an example, Expanding Brand Corporation. It's a publicly held corporation. On April 1st of 2022, they transferred 25,000 shares of non-vested stock to employee Edward. At the time of the transfer, the shares have a fair market value of $25,000. He doesn't have to make any payments in exchange for the stock. He just gets it. And it says if he stops providing services to the firm as an employee, then he has to forfeit it back. They won't be treated as substantially vested until April 1st of 2024. And it will only be substantially vested if he sticks around and stays with the company. Since they're not fully vested, he doesn't recognize any income at the grant. He makes the 83B election. He recognizes $25,000 of compensation income in the year that he makes the election when he's granted the stock. And he pays the tax on the 25 grand. If he terminates, if he leaves, or if they fire him, then he gets nothing. So a little bit of planning if there's income recognition to deal with. But if you feel very confident, like I would with the brass tax stock, I would make an 83B election all day long. What?
Are you able to make that election every time?
For each grant, you can, yeah. But you only have 30 days to do it. So you can't decide 2 years later that you want to go back and recognize the income previous year. That'd be cool if you could, but they're not going to let us get away with that. Generally, this doesn't apply to a profits interest. This is what Ryan said. Unless they claim a deduction for the compensation paid, generally, it's not going to qualify. So it sounds like 83B is really only for restricted stock awards, which is kind of a very specific situation. And so a lot of people who get equity compensation don't get to take advantage of this. But there is an election that these people can make too. It's the 83I election. And this was a Tax Cuts and Jobs Act provision that was added in. And this lets these employees defer the gain recognition or defer the income recognition for up to 5 years. And you can do this for anything. You can do it with RSUs, you can do it with ISOs, you can do it with non-statutory options, non-qualified options, anything you want. You can make the 83I election. And you can defer it for up to 5 years, but you can recognize it any time within that period, whenever you decide you want to do it. And so why might you want to defer tax out like that, or defer income out? Yeah, your income's going to go down. You're going to retire, you're going to quit that job, and you're going to start your own business, and it's going to be a couple years before you have enough income for it to matter. Maybe in the year that you got your stock, maybe you had a bunch of RSUs vest in the same year you sold a rental property, and so your income is just crazy high that year, and you don't want to have to do that double recognition. You can defer the income out to a future year when you don't have that other income. Yeah.
Now, assuming you make the 83B election, is there allowable interplay with the qualified small business stock provisions if you have a whole employee long enough?
Do you know that? No. I don't know that right off the top of my head. We'd have to look it up. There might be.
I don't think you can receive QSBS for performance services, but I'm not sure. I thought it had to be for cash or for property, but I don't know.
Yeah, we'd have to see. Okay, so we look at, if you want to do the 83I election, you look at the amount of income that you would have in that year, and you say, okay, this is what my income is going to be. You defer it out. You don't recalculate. So if you make this election, you can't go back if the value of the stock has gone down 2 or 3 years later. You can't go back and say, hey, just kidding. I want to recognize it now, but I want to recognize like the value of it today. You make the election and you're stuck with the income from the year of the election. And then you just recognize it at any point in the next 5 years. Now you can't do that for highly compensated employees, executives, we're not allowed to do that. But it is kind of a cool option that's available. The danger with 83I though is that the states might not conform. You have to check state by state. California doesn't, but that's mostly because California hates capital gains, I think. New York might, but you'd have to look. No? I tried to find it, but I didn't have the bandwidth to actually find the answer. So you've got a couple of dates to look for. It's the earliest, when you defer the income out to the earliest of the date that the stock becomes transferable, the date that they become an excluded employee. So if I wasn't an executive when I made the election, but I am now, that's when I recognize that income. If there's readily tradable stock, 5 years later, or when you revoke the election. So you say, this is a good year for me to recognize this income. I'm revoking the election. I'm recognizing it now. We already said it's calculated based on the fair market value of the stock, so we're chilling there. The risk is that you pay tax on it and the stock can go down in value, but that's the risk with anything, right? The stock market is like slightly more respectable gambling, kind of, in all of these different ways. What? I said slightly more respectable. You know, there's always a risk involved. Anytime you're investing in anything, there's a risk involved. Maybe you hit it big, maybe you leave sad. And you don't even really get free hotel rooms from playing the stock market like you do in Vegas. Other issues related to stock benefits. So there's a lot of plus sides, but there's a lot of complication with this. If you inherit stock that was employee stock, statutory options, all of these things, there's no step up in basis here. So when you exercise this inherited stock, it's treated as though it was exercised by that person. So you're still going to have an ordinary income component there, and there will still be that basis difference. And this is that thing we were talking about earlier. If you leave the company, you worked for the company, you leave, and then you sell your stock or you exercise it years later, all of a sudden here comes this W-2 that doesn't make any sense to you. This is especially fun for people who leave the state. So if you have a taxpayer who maybe worked at a place in California or New York, places where we like to tax people an awful lot, and they decide they're going to be very clever and they're going to move to Texas or Washington where there's no state tax, and then they exercise their shares thinking there's not going to be any state tax. Does that work? It's sourced to the state where they actually performed the services. And I actually had a client leave one time because he insisted I was wrong. And I was like, you know what? You go ahead and you tell California that that's not their money and let me know how it works out for you. Divorce can create a huge amount of complications with this kind of stuff. We usually split these things out. They're considered to be sort of marital assets, and so a lot of times the stock options will be split between the employee spouse, the spouse who received the options, and the non-employee spouse. Usually it's kind of written out in the divorce settlement. We like to encourage people, if they are in one of these situations where the non-employee spouse will be receiving those shares, you want to try to do actual transfers. Transfer the options, get them out of the employee's account. Because if I'm getting divorced and my spouse has all these options and I get some of them as part of the settlement, whenever I want to exercise my shares, what do I have to do? I have to go to my ex. I don't want to talk to my ex. I don't want to deal with that guy anymore. Also, he would get to know that I wanted to exercise those shares. I would be able to see certain kinds of reporting related to his information that he may not want me to have. So it's always better just to completely split them as much as you can. Now there's kind of a wild thing. The book says the 1099 NEC, and the slides do too, but what actually happens, and this is fascinating, and I have to tell you, in case you didn't know, in case you didn't believe what level of nerd we sort of operate on, if the tax tattoo didn't do it for you. When we were teaching this class initially, I was like, well, what happens with the employment taxes? Like, how does that all work? And I found a piece of regulation that explained it, and I was so excited about it. We were at dinner. It was Ryan and Jane and myself and my poor husband, my long-suffering husband, and our admin, who could not care any less about this. They just could not. And I was so excited, and we hadn't seen each other, and we were at dinner, and I was like, I want to tell you guys about this thing. And my husband was like, can you please just not do it for 45 minutes? And I was like, So we're sitting at dinner. We were at Disneyland because we're in Orange County. And so Abby and my husband go off to get a churro, and I was like, finally! I was so excited. So the way it works, it's really, really cool, I think. So when they exercise the shares, when the non-employee spouse exercises these shares, the spouse who works for the company earned that money, and they get the FICA taxes. It's their Social Security, it's their Medicare. So even if it's split out, when the non-employee spouse exercises the options, the employee spouse gets the Social Security and Medicare taxes on their W-2, and the other spouse gets a 1099 miscellaneous for the income. I know, it's totally wild, but it's really fun. So that's kind of cool, I thought. It has been suggested that I have a weird idea of fun by people who are wrong. The other thing to think about is tax brackets and AMT, right? If all of the shares are still with the ex-spouse, the employee ex-spouse, when they exercise the shares, if I want my ex-husband to exercise some shares for me, if he's in a higher tax rate, it's all going to be taxed at that higher rate. He's recognizing that income, right? They're going to withhold at that higher rate. And if they withhold, let's say I'm going to end up reporting that income, but he's got all the withholding. Is he going to give it to me? No. I mean, maybe. I'm coming. But it would be very difficult to try to get that withholding from the spouse who exercised the shares to give it to me. Yes? They would have to actually give them the money. Because if they're still being reported on the ex-spouse's W-2 and they're doing the withholding there, you'd have to, yeah, it's not happening. Not happening. This is why it's always better to separate them.
Would be willing to sign over that withholding.
Yeah.
I don't think so.
Yeah, no. Too many problems, just separate everything out. And also the AMT component. If you have the employee ex-spouse exercising the incentive stock options, if they're in a range where they would get AMT, but the non-employee spouse isn't, you may have AMT exposure that you don't need. So it's always better to just split things out when possible. Privacy is an issue, always. Manages withholdings. We talked about this. Basis records, I mean, it's hard enough to get basis records when it's not a divorced couple. Can you imagine if the ex-spouse had their accounts at Merrill and you're trying to get the information to figure out what the basis in those shares is? It would be a nightmare, right? So it's always better whenever possible to get things split out so you don't have to chase people down for records, you don't have to worry about these gain-loss reports and all of that nonsense. Now going back to the example of Ryan and myself, if you have these little companies and the little companies say, you know, I love my employees, I want to give them ownership in my company, sometimes that's a lovely idea, but sometimes maybe just give them a bonus. Because what happens when you give somebody stock in the company? They own it now, right? Like they own your company, which means that they get to see the tax returns, they get to review the accounting. Did you hear that, Ryan? And they get to access the confidential information as owners of the company. And then maybe the employee quits, but they still have stock in your company. And that can create huge problems. It can lead to issues. Maybe the business owner tries to buy the shares back, but the disgruntled ex-employee doesn't want to sell them. So sometimes it's better to do other kinds of incentives unless you really feel confident about those employees. Bonuses are good too. Okay. So now we've talked about this a little bit, but let's talk about reporting for these. 1099-Bs will tell you what the gross proceeds are from the employee stock options, And it will sometimes tell you basis, but is the basis right? Maybe, but almost certainly not, is generally the answer. And I'll tell you why, because I looked this up, I was curious. Because it's frustrating, right? We get these brokerage statements and you know the basis is wrong, you have to go figure it out. I'm like, why don't you just put the basis in there? And there actually is a reason, and the reason is kind of fascinating. Because they said, okay, listen, if you could report the correct basis on the 1099-B, but if it wasn't required, then some of it will be wrong and some of it will be right, but you have no way of knowing which is which. So the solution was, it's all wrong. And then you know it's wrong. And then you can go and find that additional basis. So the brokerage houses are actually forbidden to put the correct basis in. It has to be reported incorrectly. And this can create big problems. We have to make sure that we're tracking the basis. I think most of the companies, E-Trade frustrates me, but their reporting is pretty solid. Morgan Stanley, I think, is one of the better ones. Charles Schwab is okay. I like it when they stick that supplement right in the brokerage statement, and some of them do that. A lot of them don't. This is one of my favorite games to play with clients. I'll do the return. I'll show them the return. And, well, no, before I do the return, I see that they've got what I believe to be some stock options, some equity compensation. And I say, hey, can you track down that supplemental statement for me? And they say, no, that's all I have. And I say, no, I'm pretty sure you've got something else. And they say, no, I asked. That's all I have. And I say, all right, cool. So I send them the return. And they go, what is happening? Why do I owe so much tax? And I say, because you didn't give me a supplemental statement. And then guess what they find? Magic. It all of a sudden appears, and then we can fix it and get the right basis. Exactly. Hit them in the wallet. They pay attention. Now, there are certain kinds of things. ISOs, maybe the basis is right. That's probably the only one where the basis is going to be correct, because when we have the brokerage statement, it will tell us the exercise price of the option, which is what that person actually paid for the option. And with ISOs, unless there was a disqualifying transaction, a disqualifying transfer, the basis on the brokerage statement should be correct because they recognized the income. It was AMT, and generally there's no ordinary income component there, so that one's probably okay. With an NSO, what you're going to see on the brokerage statement is the purchase price. So the exercise price is what shows up there, but none of the ordinary income will be reported. So there will be some basis that'll look like something happened, but it's not going to be the correct one. The ESPP will show the exercise price as the basis, but it won't have the wage amount. And RSUs, it's just going to say 0. It's not going to show you anything at all. Now, sometimes companies merge. A lot of times, like I said, if their W-2 and the name of the stock they sold are the same, that's a pretty good clue that that's what's happening. But sometimes companies merge, they change names. If somebody's using one of those big payroll companies like Insperity or TriNet, where it doesn't actually say what the name of the company is, it just says TriNet or Insperity, sometimes that's less helpful, so you have to ask more questions. Sometimes the payroll companies aren't the best at doing it, but you don't want to do double tax. And this client, the one that I was talking to on October 6th, she frustrates me in a lot of ways, but so I spent an hour on the phone with her and the Merrill guy, and the Merrill guy said, no, there's nothing. We finally found something that showed some compensation, so I used that to figure out the NQSO basis amount, and I found the old forms that showed me the ESPP shares, so I was able to go in manually and calculate the correct basis, and I charged her for it. It saved her $5,000 in tax. I did not charge her $5,000 to do it. I sent her the bill, and she goes, I don't understand what you're charging me for. And I said, I know, she's getting fired this year. And I said, well, I spent an hour on the phone with you and the guy at Merrill, and then I spent another 25, 30 minutes calculating your basis for you based on the information that we had. It saved you $5,000. We don't have to put that on there. So if you don't want to pay the bill, I can just take it right off. It's up to you. Would you rather pay $5,000 more in tax, or would you rather pay my additional invoice? And she paid the invoice. We got to charge for this work, though, because it is work. It takes time. It takes effort, and tracking that stuff down. If I just get, the brokerage statement that has the supplement, I'm not mad about it. I'm just going to do it. But, it's good times. Okay, state reporting. When you're doing the work in a state, generally the income is sourced to the state where you are performing the services. Because equity compensation is payment for services, it's going to be sourced in the state where you're actually working. If you move into a different state, and that state has state income tax, when you exercise those options, you may have tax in the state where you actually earned those options and in the state where you live, which can be super fun because you get double taxation here. So non-statutory Nigel, he was a resident of Michigan when he was granted the options. In June of 2023, he permanently relocates to California because he loves paying state tax. He also likes the weather. On August 1st, the options vest. What are the state tax consequences? Is he going to have tax in Michigan? Is he going to have tax in California? Yep. The question is it a creditable tax? And yeah, if he's got the double taxation for California, we can take the other state tax credit there, and so he can help to mitigate that a little bit. If he moves from California to another state and he's a non-resident, then if he was performing services in California, it gets taxed in California. Sometimes the states try to be really helpful, and they give you documents to help you sort it all out. I have an example of what that looks like in a minute. But non-resident Nancy lived in California when she was granted her options. All of the services to the company were in California. She leaves the company, moves to Washington. A couple of months later, exercises her options. Where is that income going to be taxable? California. Is she going to get a credit from Washington to offset? Nope. That's the downside of a no-tax state. Now you can figure out, if you can't figure out exactly how to allocate it out, there are some methods you can use. The days worked is a reasonable method to use to split that income out. This is a real spreadsheet that I got from a client, and I'm trying so hard. I made it this far, but I'm going to do it. What is with your non-resident W-2s here, you guys? What is up with New York non-resident W-2s? You explain yourself, Phyllis.
I'm not explaining myself, but it's actually statutory that the state wages have to match
It is the wildest thing. Well, and look, okay, so sometimes it's fine. Sometimes, you do the days worked, that you do that non-resident wage allocation, which is cool if somebody actually worked in New York for some time.
If you make the mistake of not doing the paperwork, they send you a bill based on that state wage.
Oh, I'm sure they do, yeah. I have a client who is an actor and filmed an episode of Law and Order 15 years ago, and so he gets a couple dollars of residuals from New York. It's New York source income. There's no question about that. But he gets a W-2 for $1,500. The episode aired one time, it's 25 cents. How am I supposed to figure out the number of days he worked in New York when he didn't set foot in New York? They just replayed that episode of Law and Order. It is insanity.
California sends out those same W-2s.
No.
Oh, yes.
California, only if it's all California income.
His hand was in a movie.
Oh, no, California taxes it. No, hold on, back up.
We get a W-2 for $42
Yes, okay,
every year.
yes,
Because they
but,
that movie 86 times.
no, I don't have a problem with the income. I agree that it's New York source. That's not my ish. Tell me the number. Just tell me how much income it is. Why do I have to guess? I might as well just throw a dart. It's crazy. Yes, Brian.
While we're on this discussion, New York conforms to both 83B and 83I,
Ooh.
which was, I don't like the way that you guys have your code written out here, but that's a different problem. And then ISOs and RSUs can be eligible for qualified small business stock.
Very cool. All right, so that's my California is a crappy tax state, so we can't really criticize, but it's kind of fun when there's another, exciting.
The bigger question is, why is somebody knowingly moving to a state with a higher marginal tax?
Because the weather is beautiful. I have to tell you, like, coming out here.
Are you at a fire sale in Malibu?
Listen, if the low at my house gets to the high here, something is very wrong, is all I'm saying. You can't even buy real jackets where we come from. Anyway, but I agree. The guy's hand in the video, I agree, that's California income, but you know, it's the fact that we report the actual amount of income that was earned in California, not everything. And this can get especially crazy because look at where this guy was earning his options. California, New York, New York, New York local, even more fun. New York City, yep. California, New York, California. So he's gonna get a W-2 for all of these RSU vests, and what's it gonna say? It's gonna say he's got $250,000 of federal wages, $175,000 in California wages, and $250,000 of New York wages. And the problem is, I don't know how much of this goes where. I'm supposed to go in here, because this is my favorite part, is I go in, I'm like, okay, I'll figure out how much is actually New York source. That's cool. Then I get to do that thing where you like tweak the days to try to get as close as you can, right? I mean, honestly, that's. Well, it doesn't actually matter if he lives there. This guy did move partway through the year, which made it extra funny. Well, but you can't just use the dates. That's the thing.
Time and dates and the amounts earned during those periods.
Yes, so when you're doing it, you have to do the dates and the times and the amount earned and all that stuff.
Make sure you ask
But
him
if,
if he didn't receive any money after he moved into California from New York.
yes, but if you look at like, so he was awarded these shares from 2021 through 2023, and they all vested during 2023, but some of them were actually related to work that was done in New York, and some were related to work that was done in California during different periods of residency. So trying to make sense of something like this is insanity. And the reporting is 100% not gonna be right. And so you just have to kind of do your best. But this, is this helpful? And I was like, no. What am I supposed to do with this? This is insane. Okay, what time do we go to? How am I doing on time?
You have
20 minutes, okay, beautiful. So let's go through sort of a comprehensive example here. We can show you what they look like. So this is, I think, an E-Trade statement. This is kind of what they look like. And this right here, you'll see, $0 of basis. We've got $216,000 of proceeds with 0 basis. So what probably is that? RSUs, right? Right out of the gate, we know something's going on here. But these guys up here, we've got 26,000 and change of proceeds and 15,000 and change of basis. So would that right there give you a clue that something was missing? I don't know, probably not. If this wasn't here and you just saw that first column, would you think that something was wrong? No.
If the dates were like a day or two apart, yeah, otherwise there's no way to really.
Yeah, if the dates were a day or two apart. The other clue for ESPPs, which is what that first group of shares is quarterly purchase dates. Usually when you're acquiring ESPPs, they buy them quarterly. So if you see that the purchase dates, the date acquired is like every quarter, that's a pretty good indication that that's an ESPP. If the name of the employer doesn't match the name of the company they sold, which is the other big dead giveaway, 0 basis, 100% we know that that's gonna be RSUs, probably. Because again, it could be something weird. We've got more ESPPs here, more RSUs there. This is what it looks like on the actual brokerage statement that we get. Then, we already talked about this, we know how to kind of find them. This is what the supplement looks like. And this is the E-Trade supplement, and it makes me insane. It makes me absolutely insane, because look at what they did. Couple of ESPPs, couple of RSUs. You can't even just total things up. You have to go in and add each individual stupid thing one by one. Fidelity's worse? Well, Merrill is on the worst in my opinion right now because they don't even give you anything, allegedly. RBC, those are the horrible ones, right? I had never seen one of those until last year, and I wanted to set that broker statement on fire. It was insane the way that was done. Wild. So you go through and you kind of identify, okay, like if you look at, these are all labeled here as the different batches. So you kind of go, oh, I can't go backwards. Hold on. I want to show you this one because it's fun. So just remember what those numbers look like. So see, we've got E3 up in the top there. The first one is $19,079.85. And then, is that one on here? That'd be cool if it was. Okay, that one's not on here. It's in there somewhere. But we just would go through and say, okay, this one matches that one sale that I had. You see this ordinary income adjustment here. This is the amount that was on their W-2. And this is the amount that we need to add into their basis to make sure that they're not paying tax on that income twice. So we go through, we add all of them up, and then our 8949 will look like this. We say, hey, we've got these transactions here, sales proceeds. If we have the ESPP shares and NQSOs, they report them as covered transactions. So we have to tell them what the incorrect basis was. We tell them the basis is wrong. We make the adjustment, and we have our correct gain or loss. For the RSUs, those are reported as non-covered transactions. So they're going to have that zero basis. We make the adjustment there and tell them what the actual gain or loss is. This one shows we've got some ISOs here at the bottom. It tells us, hey, this was the number of shares that were transferred through ISOs. And then when we actually sell those ISOs, we'll just have the basis on our 1099-B. Okay, so we're going to wrap up with a little bit of fun tax planning stuff. So I think that this is going to become especially important now because so many of the OB3 provisions are income driven. So if you have taxpayers who are looking to exercise options, it used to just be a question of, okay, we don't want to jump brackets or we don't want to lose out on, the active participation in rental or something like that. But there are so many other AGI-based deductions now that managing that is going to become more and more important. But when we look at, okay, you have these many shares you could exercise, you run the numbers, you go in and actually calculate what their income component would be, and say, okay, is that going to kick you out of QBI? Is it going to boot you out of your active participation rental losses? Is it going to take away your education credits? Is it going to bring your state and local tax limitation from 40,000 down to 10? Because maybe you want to wait a little bit this year, exercise some, and then exercise the next year so that you don't lose out on those big deductions. There's going to be a lot more planning involved with those kinds of things, I think, now under OB3. If you can defer the income out, if you know you're going to retire, you hold off and exercise the options when your overall income is lower. That's a great strategy. Strategy. It could be a tragedy. Tax planning strategies. Look out for the credit for prior year AMT. Maybe your client didn't exercise the options when they were your client, but maybe they did have an ISO exercise in previous years and paid AMT. You want to look for that prior year AMT because sometimes those credits it all depends on what the prior preparer gives the client as part of their package. I try to give the clients everything they could ever possibly need because I don't try to hold my clients hostage. If they want to go somewhere else, they can go. I'm sad, but it'll be okay. And I don't want the other preparer, the new preparer, bugging me constantly for the depreciation schedules that I didn't include in the taxpayer copy. So I try to give them everything. You give them the carryover stuff. And so we'll say, okay, yeah, we've got this credit for prior year AMT. Look for that because they may have credits that they can carry forward that they can use in the current years. So watch out for that one. It's always a good idea to go back at least 1 year. I like to go a couple years back when I look at new clients' returns just to make sure there isn't anything crazy that happened a couple years ago. The net investment income tax sort of throws a wrench in some of this, I think, when we're doing planning. And especially if you have a taxpayer. I had this situation just recently where this guy called me. He said, I have these options. I'm going to sell them. I just can't figure out if I should exercise them now and then, hold them for this period of time. And so trying to figure out the timing of the sale, he had already hit the Social Security wage base. So he was losing out on that, what is it, 6.25? Is that what it is? 6.2. I'm tired, you guys. So he doesn't have to pay that 6.2% of the Social Security tax. So even with paying the actual Medicare he was paying through the payroll taxes was less than the net investment income tax that he would have had to pay on a short-term capital gain. So you have to kind of run those numbers and see what made the most sense to exercise and hold versus exercise or sell. There's no one-size-fits-all answer for these stock option questions ever, which is kind of the fun of it. Every single situation is going to be different, and you have to look at all of these different factors. If you think the price is going to go down, there are a couple of strategies. Sometimes it's good to just exercise and sell all in one go. So you recognize the income, but at least you don't lose any money. If you exercise and hold and the stock goes down, you've basically just built in that loss. You've paid ordinary income tax on money that you don't have. So if you think, I bought this, I work for Beyond Meat, it doesn't look like things are going super great, I'm just going to exercise and sell my options right now, at least you lock in that income and you don't lose any more. If you think the price is going to go up, then there are different strategies there, exercising and holding, selling it, or exercising in bunches so that you don't get one big income event all at once. There's all kinds of different strategies to look for. If you have incentive stock options that you've exercised, so let's say I do a big ISO exercise. I've got a couple $100,000. I've got AMT as a result of it, and I do my exercise in January. Then in November, there's some huge scandal with the owner of my company. He was at a Coldplay concert. Now the stock has tanked. And so I have all this AMT, and the value of the stock has gone way down. What's my best move there? Ditch it. Do a disqualifying transaction. Then I don't pay AMT, I just have ordinary income. So I've saved myself paying tax on a bunch of phantom income in the form of AMT. So keeping an eye on that kind of stuff is always a good idea, especially if things are going down. I want to get to the fun example here at the end. Let's see. Okay, so we're going to wrap it up with this example of hold or exercise and hold versus wait and exercise and sell. Because the exact same situation can have two very different outcomes depending on how you do it. So for this example, we've got two different taxpayers, and for purposes of this example, they are exactly the same, which is totally common, right? That's my favorite thing. People call and they're like, well, my coworker got this much money and I didn't. And I'm like, well, are you the exact same person with the exact same life? Because otherwise, that's very likely. So, but these are the exact same person. One of them is named Evan, the other one is named Patty. Evan is eager, Patty is patient, but aside from that, they are exactly the same. All of their income, everything else, exactly the same. They each are granted options to purchase 7,000 shares of the employer stock for $40 a share. So we're assuming that there's going to be an increase in value. We're looking at 10% per year. They've got $7,000 shares, current stock price $80, exercise price $40, so there's a $40 discount right now, right? That's the spread, that's the bargain element. Assuming a 10% increase, top tax rate 37%, capital gains 20, and we're assuming this increase in value. So in 5 years, the stock price will be $130 per share. Is everybody with me so far? All right. So Evan exercises the shares, and he's going to hold them for 5 years. So he recognizes $280,000 in taxable income because of the exercises. It's 7,000 shares times the $40 bargain element. So he's got $280,000 that's going to drop onto his W-2. Now, he doesn't have the cash to cover all of the exercise price and to cover the taxes, so he sells off 3,500 shares to purchase the stock and then another 1,700 to cover the taxes. So he's left with 1,800 shares. Could he just pay out of pocket for it? I mean, does he have 280 grand sitting around that he could use to buy the stock? He wishes, right? So probably this is his only option. He recognizes the income, he's got 1,800 shares left, and he's holding them. So he waits 5 years, he sells the remaining shares at $130 per share. The gross proceeds are $234 from the sale. And he's gonna pay capital gains tax on that, right? Capital gains plus net investment income tax. His total tax that he pays, $27,000. So his total realized after taxes is $207. It's not bad, right? Nobody likes this strategy. Okay, so that's Evan. He had an okay payday. Now Patty doesn't exercise and sell, she waits. She exercises and sells her options 5 years later. Now at this time, the fair market value of the shares is $130 per share, so she's gonna recognize $630,000 of income as a result of the sale, which is the 7,000 times the $90 bargain element, because she bought them for 40 bucks, right? Gross proceeds from the sale, $910,000. She exercised, she sold all in one go. She's gonna have to pay for the exercise, so she uses some of it. 7,000 times 40 bucks, $280 of the sales proceeds go toward the exercise. She's gonna pay federal and state income taxes as well as FICA to the tune of $305,235 bucks. But she walks away with $324,765. That's $117,165 more than Evan after the same amount of time. She paid way more tax, yeah? But she also walked away with a bunch more money.
Plus, some of it went into her Social Security account.
Yeah, that's true. Some of it went into, credits towards Social Security. She gets a little extra there. A little bit more Medicaid. Now we're assuming that's gonna be around when, I like that. Now, there will certainly be people. There was somebody, we taught this one time, and somebody in the class said, I don't care how much more money I walk away with, I'm not paying that much more tax. He was so excited to stick it to the government that he would sacrifice $120,000 just to stick it to the man. Which I respect that, but I do not agree. All right, so we'll wrap it up. In the handout, there's a comparison chart that sort of breaks down what the different benefits are, how they're taxed, when they're taxed. There's also a glossary of all the different kinds of terms. And that's pretty much that. Does anybody have any questions? Any exciting things? Did everybody learn something? Yes? Everybody learned one thing? Okay, awesome. I don't know about the not bored thing. I saw a couple of people sort of, I'm gonna blame that on lunch though. So cool, well thank you so much. Thank you for your attention.